Good afternoon, ladies and gentlemen. I warmly welcome you for all of you for another seminar jointly organized by the Seminars and Conference Committee and the Taxation Committee of the CMA Sri Lanka, the professional management national accounting body in Sri Lanka. To start the proceedings, I would like to welcome Professor Lakshman R. Bhattavala, founder and president of CMA Sri Lanka, to deliver the welcome address.
Thank you very much, Mr. Gajendra, who is, of course, our chairman of our taxation committee and also recently been appointed as the chairman of Sanasa Life. So my congratulations to you. Then our eminent speakers today, Mr. Suresh Pereira, who will be making the presentation, and our panelists, Mr. N.R. Gajendran, who is a veteran in the taxation field, and our members and participants. As Mr. Gajendra mentioned, that this is a CMA Sri Lanka webinar on tax reforms in the IMF report. So the purpose of this webinar is to shed light on the new tax measures agreed and included in the staff level agreement at the second review of Sri Lanka's Extended Fund Facility or EFF program of the International Monetary Fund. So I must really thank Mr. Suresh Pereira, who is the Principal Tax and Regulatory of KPMG, for kindly agreeing to make his presentation, because he's been someone who's been working with us closely and one who is really conversant in all these areas that are there. So then also there we will have Mr. Nista Sulaiman, who is the tax partner at Ernst & Young, who will be the moderator of the session. And our panelists will be Mr. N.R. Gajendran, the senior partner at Gajman, and of course, very, very senior and veteran tax consultant. And will be also joined by Mr. Atul Ranavira, the managing partner of Ranavira Associates. So we are really happy because this is a knowledge sharing session organized by CMA Sri Lanka. Of course, CMA is the Institute of Certified Management Accountants of Sri Lanka and the national professional body. And this is also a CPD program, a continuing professional development program. Now, we are really, as CMA Sri Lanka, we are engaged in equipping future accountants and also updating the knowledge of our members who are there so that they will be aware of the latest taxation and other developments that are taking place. I must also pay a special word of thanks to our presenter and the panelists because as I said, this is a knowledge sharing exercise which we are doing, and you all know that they have given of their time and knowledge. It's free of charge, so I must thank them because that has helped us to share this knowledge with everyone. So I hope you will all value the services that they are doing, because it is of tremendous importance, especially at a time when we are having a very, very grave problem of a crisis situation. But now things are improving, and I'm sure all of you are quite well versed with it. Then the other area, of course, is that in order to do this sort of professional programs to equip future accountants, we have just launched our new syllabus, which is being used by our students as well as our educational institutions. Now, in this, we have three key areas which we know is really a requirement to build professional accountants, and those are the digitally enabled, as you know, that's the most important thing, or also value driven, where you will create value, and of course solution savvy, so that the syllabus will cover all these areas which will really take them to become to be equipped to future accountants. And we've also tied up with a few of the foreign bodies. One is CPA Australia, and other one, of course, ACCA UK, where they have a pathway and will be able to get many exemptions in that area. I must also remind you that we are the CMA National Management Accounting Conference will be held on the 24th and 25th of July at Sheraton Hotel on the theme Navigating Stability Towards Dynamic Growth. So I do hope all our members and all others who are participating at these webinars, because will be present, because these are physical one, and we like to see you there, and also supporting at the, sorry, it's a Shangri-La Hotel. I said Sheraton, it's a Shangri-La Hotel that we are having it. And we are very happy and we like to see all of you there and support CMA, because if you support us, then we can do more and more events of this nature. I must also say that in the case of taxation seminars, and especially this one, it have been maybe given in the newspapers quite a lot. One, of course, is the on the rental income, on the imputed rental income, where one has to pay tax. So I don't want to talk on that, but our presenter and the panelists will be able to shed more light on that. So let me thank everyone for participating at this. We had over 700 registrations. Normally 50% will participate. Already there are 270. I'm sure there'll be many more who will be attending. So while thanking our presenter and our panelists and the moderator, I will also wish to thank all our participants, and that they will be able to really also send questions on the Q&A and clear any doubts that they have, and we be able to get more knowledge on what is being done. So thank you, and over to you, Gajendra.
Thank you, sir. Next on the agenda is the presentation on tax reforms in the IMF report. To do the presentation, I have the honor of inviting Mr. Suresh Pereira, Principal Tax and Regulatory at KPMG. Over to you, Mr. Suresh.
Suresh, you are having a presentation, PowerPoint?
Yes, good afternoon, everyone. Let me begin by thanking CMA and Mr. Vatawala for, Professor Vatawala for extending this invitation. Yes, I do have a set of slides, so let me share that and then we'll. Is it shared?
Yeah.
Here.
Okay.
Right, okay. So as we all know, what we are going to do during the next 1 hour, 1.5 hours is to discuss about the tax measures in the IMF report. So what is this IMF report? This is in relation to Sri Lanka's extended fund facility program with IMF. And there was a first review that happened in...
Suresh, it's still not come. The presentation has not come.
Oh, 1 minute. You all can hear me?
Yeah, we can hear you, but not the presentation.
Okay. 1 minute.
Now, okay.
Presentation.
Then put it to presentation mode. Do you have? No?
1 minute. Is it okay now?
Yeah, fine.
Right, okay. So what we're going to look at is at the second review of the program, the staff level agreement has been issued June 14th or somewhere there, and it's dated 29th of May. So the content of that restricted to the tax measures is what we are going to discuss during the next 1 hour, and then maybe go for a Q&A session in relation to this.
Suresh,
So,
you have put to presentation mode, or just check and see whether it is. Sure.
Just 1 minute. It's in presentation mode. It is in presentation mode.
Right, okay.
Right. So what are the key measures, the key tax measures that are in this report that are of interest to us? The first one is the imputed rental income tax. I'll speak in detail in relation to that. And then there is also a reference to substitute special commodity levy with imposition of VAT. Special commodity levy, as we all know, is the tax that is levied or levy that is levied at the point of importation of essential goods. And then, of course, from there to increase the corporate income tax rate applicable to sin industries, that is alcohol, tobacco, and betting and gaming. And also to implement VAT on supply of digital services. Of course, digital services are liable for all the taxes that are applicable in Sri Lanka when it comes to resident digital service providers. But when it comes to non-resident digital service providers, due to the peculiar, due to the tax framework that we have in Sri Lanka, due to the tax framework that is there in most of the other countries, digital tax service, not digital tax services, digital services provided by non-resident service providers go out of the tax net. And in relation to that, there are many measures that have been taken by different countries. And Sri Lanka now basically is focusing on this arenas. And there is a proposal to introduce VAT with regard to that. So I believe that they're talking about is digital services provided by non-resident service providers and not the resident service.
Mr. Suresh, sorry to trouble you, but still it's on the first slide only. It's not.
Okay. Just give one. Can you see the new tax measures slide? Or are we looking at the cover slide?
Cover page, yeah.
Cover page.
Okay. Give me 1 second.
All right, now fine.
Right, now we're in the second slide?
Yeah.
New tax measures, yeah. So I came up to the digital services, and then, of course, the all-important, or how do I say, the sensitive proposal to exempt, to remove the exemption applicable to service exporters. Service exporters are persons who are rendering services to persons outside Sri Lanka and earning foreign currency into Sri Lanka currently enjoy income tax exemption, and that income tax exemption is to go out, to eliminate. That's the proposal, and we have been expecting this. And then, of course, there is also a reference to, or there's emphasis in this report that with regard to the importance of introduction of property taxation, at least from going forward 2026. So that's what we are going to look at during the period, right? So with regard to revenue and spending measures in 2025, there's a table that has been given in the included in the IMF report. I have reproduced that same thing here. So you can see here from property tax, at the first review there was a estimate of 1.2 of the GDP to be collected. And you can see when it comes to the baseline, the second column, it has been reduced to 0. In other words, in 2025, there is no revenue expected from property tax, though there was an expectation earlier. And the new measures have been agreed in the staff level agreement.
Just a slide. Next slide.
Can you see?
Till second one.
Oh, does it say IMF EFF program? No?
No, new
No,
tax
no.
measures.
What is that? No. There's something. Okay. Just give me 1 second. I will come out of the presentation mode and so come out of the presentation.
Right. Revenue and spending measures.
Okay, right. So as I mentioned, basically 1.2 was the estimate at the beginning of the year at the first review, and now it has been abandoned. So nothing will come from property tax during the 2025, but from imputed rental income tax, you can see 0.04% is expected. And then from the elimination of the exemption on the service exporters, there's another number expected, and you can see the numbers that the revenue that is expected from each tax measure included here. I won't go into the details here, but what is important for us is in March 2023, when the first report was out, there was a reference to implementation of nationwide property tax, wealth tax, and wealth transfer taxes in March 2023. So it is that has been either deferred or abandoned. And in the second review, there is a reference to the imposition of imputed rental income tax, a new concept in Sri Lanka. So this is the exact the wording that was there in the March report. According to that, by January 2025, property tax and inheritance tax and the gift tax was to be in place. And now there's no reference to that. It's the imputed rental income tax that is being contemplated. So let's see, what is this? Can you see the slide? Is it moving now?
Yeah, can see.
So
Correct.
What is imputed rental income tax? That's what we need to see. Right now, this is something new to Sri Lanka. At the same time, according to the research I did, OECD, etc., imputed rental income tax is there in 4 countries. We'll look at those 4 countries later a little bit. So basically, Switzerland, Denmark, etc. And now, what is being introduced in Sri Lanka under this title, imputed rental income tax, is to impose a tax on deemed income that will come on 2 things. What are the 2 things? Owner-occupied residential property, and vacant residential property. So this is going to come. This is a deemed income from residential houses, not land. Land is excluded. Not commercial accommodation, not rented property. Either owner should be in occupation of that residential house, or it is a vacant residential property. So that's basically the subject matter. On those are the in relation from those 2 properties. What is the if you give that house your house on rent? What is the rental income that you can expect? Or if your residential house is vacant, closed down, and instead of that, if you rent it out, what is the rental that you can get? It is that is being taken as the tax base. Imputed rent, not the actual rent, it's the imputed rent. Right. Yeah, okay. So it's a deemed income. So it's not the actual income, deemed income, potential income that can come from renting out your own house or the house that you are not occupying, that is closed vacant house, right? So what's the timeline? When is this going to be implemented? According to the timeline given here, it's the 1st of April 2025. So we are in month of July 2024. In how many months? Maybe another 10 or 9 months. April 2025, this is going to happen in Sri Lanka. Also, there's a reference that there will be an exemption threshold, and tax will not be a flat tax. Now, capital gains tax is a flat tax, 10%. So this is not going to be a flat tax. This is going to be a graduated tax, just like what we have in our individual income tax system. A graduated progressive tax rate schedule is what is being referred to here to ensure progressivity. So there's an exemption threshold, but there is no reference to a first house being exempted. No? So that's something that we have to keep in mind. Though subsequent to the issuance of this report, references have been made to that extent, and that may be accommodated, but then there has to be a change with regard to the content of this, or change or deviation from the content of this report for that purpose. So that, in brief, that is the tax that is being contemplated here. Now, in order to implement this tax, there are administrative measures also that have been referred to in this report. also giving timelines for implementation of these admin measures also. So what's that? There's a database that is being referred to. So what is this database? This is a database on estimated current market values of the property. So the property type, annual values, latest assessment date to decide the capital value of the property. Then second, there is a reference to creation of a register, not a normal register, digital sales price and rent register. So it is going to be a digital register. And this will be accessible to the Inland Revenue Department, Valuation Department, Land Registry, and also to the general public. So now, because this register is going to be accessible to the institutions that I mentioned, these institutions can use or is expected to use this register as the key source for assessment of the property values used for several taxes, like in addition to the IRIT, the imputed rental income tax, the normal income tax assessments, the capital gains tax assessment, the stamp duty, normal local recurrent property taxes. For all that, this register will be used as the base. That's what the IMF report is saying. And in order to ensure that this process will happen, there is a suggestion, or there is a proposal, or there is an agreement to amend the Notaries Act also. Do I say proposals? These are not proposals is not the correct term. These are measures that have been agreed and included in the staff level agreement. And also, as I go on, I will point out in the IMF report, it says these measures have been approved by the cabinet. So why the amendment to the notaries ordinance? That is to ensure the application of the register, digital register, by the notaries, because there will be an obligation imposed on the notaries to update the data into this register as and when they execute the relevant legal instruments, right? So now, what is interesting is the timeline implementation. So as I said, basically, this act says that this report says that the cabinet approval has already been granted. So I don't know whether this reference is correct, accurate, or whether cabinet has approved and nobody's served. Right. So that's the important thing. I have not checked all the things that have been approved by the cabinet, but in the report there is a clear statement that the cabinet approval has already been obtained, and then it says this will be submitted to the parliament, and parliament approval will be obtained by the end of July. So end of June was the timeline for submission to the parliament, and obtaining the parliament approval by the end of July. So now what is this presentment to the submission to the parliament and obtaining the parliament approval? I presume this is with regard to what is approved by the cabinet, in other words, the imputed rental income tax, to be gazetted and then bring it to the order paper of the parliament, and then go through the general parliamentary process, first reading, second reading, third reading, that's in between the committee stage amendments, and then vote passing by the parliament. That's the way parliament approves things, and then certification by the speaker. So the timeline for that, according to this report, is the end of July. So we are now in the first week of July. And also, there's another timeline given with regard to the creation of the database, collection for the database, and for the digital register, collection of the provisional. Then by December 2024, the database to be in place, and by 1st of April 2025, the new tax to be implemented, along with the amending of the Notaries Act is what is referred to in the this one as the timeline, right? So April 2025. So this is what I...
Today, excuse me,
yes.
Can you see whether you can get it full screen? Because there is only part, half is there. Just see whether we can get it.
Is it coming now?
Yeah, fine. Now fine.
I think fine.
Right. Thank you.
Right. Okay. So basically, you can see here, this is the procedure to be followed in Parliament to obtain Parliament approval for the enactment of a statute. And according to the IMF report, this stage to be completed by the end of July. Right. So I don't know whether the timelines are being adhered to, or whether it is practical, or whether there will be big changes with regard to this thing, notwithstanding the cabinet approval being obtained according to the report. But before that, let's try to get an idea with regard to the rationale.
To change my name.
Yeah, right. To get an idea with regard to the rationale of the property tax and the rate. Now, all taxes basically are to collect revenue to the government, right? So that is the base idea of the property tax, as well as the imputed rental income tax. I'll call it IRIT. When it comes to property tax, there is another objective also. Moment you impose the property tax in a country, if there are properties that are not generating income, then those properties become a liability for the owner. So what happens is when you get bare land, etc., which are not not contributing to the economy, the owners are tempted to dispose those properties, and any person who's going to own that property will develop and get and put it and add it to the economy. So that one objective of the property tax is to ensure people will not own land, say bare land, which are not contributing to the economy, to compel that kind of property to contribute to the economy. Now, when it comes to IRIT, you can see this tax is on the houses occupied by the owners or houses that are vacant. This is not on land. So if Sri Lanka is looking at developing the unused land in Sri Lanka, yes, property tax will do that thing, but not the IRIT, right? Because the bare land is not captured here. And also, okay, maybe in relation to the houses that are closed down, yes, the owners will now be tempted to either dispose those houses or ensure those houses are rented, so that it will again become useful for the economic activities in the country. Right. Now, there's another important aspect. Now, when you study the rationale in other countries, that is the Switzerland, the Denmark, the countries that I mentioned, the rationale for introduction of the IRIT is interesting. So when you look at Switzerland specifically, they have the right to deduct the owner of the house, person who is owning a house, has according to the tax framework in Switzerland, they can get mortgage interest as a tax deduction according to the law. Mortgage interest means the interest on the housing loans, housing loan taken to put up the house. In addition to that, maintenance cost also deductible is the available deduction to the homeowner. Now, when you compare that homeowner with the person who is renting, that means the renter, that means the tenant, he does not get a deduction. So there is no parity between the tax parity between the homeowner and the renter. So this is why in those countries this tax has been introduced to create tax parity between the homeowner and the renter. So deemed income tax, income is added to the income of the person, and then against that deemed income, a tax deduction is being given by way of on account of mortgage interest, the interest on the housing loan, and the maintenance cost. But now, when you look at the tax framework in Sri Lanka, can you and I deduct maintenance cost in relation to the houses that we are occupying? Do we have the right to deduct mortgage interest? Do we have the right to deduct interest on the housing loans according to the current tax framework in Sri Lanka? No. Once upon a time, yes. Before 2011, interest on the housing loan was tax deductible, and when the new Inland Revenue Act was introduced, after I think the second or the third amendment, there was this expenditure relief concept introduced, and one of the reliefs was to give a tax deduction for the interest on the housing loan, but then expenditure reliefs were taken out. So as per the current tax framework in Sri Lanka, we cannot deduct the maintenance cost. We cannot deduct housing loan interest. So our tax frame is different. The reason why IRIT has been implemented in Switzerland and other countries is not the same framework that we have in Sri Lanka. So the question mark arises, is this the right tax? Because there's no, the rationale that used in other countries is not applicable to the Sri Lanka because our tax frames are different. So look at the countries. According to the OECD country report, 4 countries are being pointed out as implementing Denmark, Greece, Netherlands, and Switzerland. So, like Switzerland, again, you can say, according to the Swiss law, a resident taxpayer owning a house or an apartment and living in his house, that means own-occupied house, will generally be taxed on the deemed rental value of this property, which will be added to the individual's taxable income. Now, this is very interesting. So what happens is, this is the part of the income tax in Switzerland. It is added to the taxable income, and against that, in calculating that, basically you can get a deduction from maintenance costs and the mortgage interest expenses. And something interesting, if IRIT ever happens in Sri Lanka, what will happen to the properties abroad, foreign countries? Now, in Switzerland, according to their law, if a person has a immovable property outside the Switzerland, that is also taken into deciding the actual in calculating their tax liabilities. In other words, houses outside Switzerland are also taken into account. Now, Netherlands, what is the situation? Everyone who owns a home must be add an amount to his income, that is the imputed rent, the imputed income from the owning a home. This income is calculated based on the so-called worst value of the house. Worst values are based on market values. So again, the similar concept. Assessments are carried out in the same way throughout the Netherlands according to the strict rules. So values are decided by the building's characteristics, official valuation, selling price, or selling price of the adjoining house properties, the nearby properties. Then again, you can see mortgage interest and certain expenses are deductible according to the Netherlands tax framework also, but we don't have it in Sri Lanka. Now, when it comes to Greece, actually, it's not basically the house that is being looking at. You are basically trying to tax the luxury living. So again, the imputed or the income is imputed on private cars, big private cars with large engine power. Then the airplanes, helicopters, swimming pools, private yachts, boats, again, the big ones. Luxury items. On luxury items, an imputed an amount of income is imputed, and on that imputed income, a tax is being levied, right? So it's not just the houses. Right, so again, as I mentioned, why IRIT in other countries? To create the tax parity between the homeowner and the renter. Why? Because the homeowner has 2 tax deductions, whereas the renter does not get that parity. Therefore, there is a mismatch. So to eliminate that mismatch, income is imputed on the homeowner, and then he's basically allowed to deduct those 2 expense items. Thereby, the policymakers are saying that, okay, now there's tax parity between the 2 parties, which again is not the case in Sri Lanka, as I mentioned earlier. Sri Lankan tax framework is not same as in Switzerland or the other countries. So the point that I'm saying is, IRIT does not fit into the Sri Lankan tax framework if you look at the rationale per se. Right, so what is the difference between the property tax and the IRIT at a very basic level? So property taxes are normally levied on the assessed market value of the property, whereas when it comes to IRIT, it's not the value of the property, it is the notional rental income. And it in case property tax normally goes for all properties, could be land and buildings. In certain jurisdictions, going beyond land and building could move to other properties also. So IRIT is always on owner-occupied vacant residential houses. So basically, it's a property value and the rental income is the difference there, right? The question that I'm asking is, if IRIT happens to come, this will this be restricted to the Sri Lankan owner-based home, or Sri Lankan owned houses only? What will happen to say if I have a apartment in Australia? Will I have to be will I have to pay a tax on that also, the IRIT tax? Right now, the IMF report itself is going on to say that this is a tax imposed on the income of the individual, and this is not on the property itself. So if I'm a resident in Sri Lanka, my worldwide income is liable for tax. So if I have a residential house in, let's say, Australia, it becomes part of my worldwide income. Right? This is the income that we are talking of, not the property itself, worldwide income. So subject to the exemptions that are there, maybe it's a foreign source income exemption. If I'm not to invoke those, there's nothing to say that, okay, this Australian house will be out of the IRIT, but for that, again, owner, I have to occupy that house. But then the complicated point comes, okay, if I'm occupying that house in Australia, would I be a resident in Sri Lanka? Therefore, would my world income be liable, or only the income from Sri Lanka will be liable? Therefore, the deemed income on my Australian property house should not be included. Something to think about that, right? But on the other hand, I am in Colombo. I have a residential house in Melbourne, and it is vacant. I have not rented it. It's closed down. Now, the imputed rental income from that is basically my worldwide income. So then it should be considered for calculation taxes in Sri Lanka. And again, then we have to check and see, okay, whether the foreign source income exemption could be invoked to take it out. So going forward, sometimes we may get a little bit of clarity also in relation to that. I just did a rough analysis according to the current tax law as to how this will happen if I have a house in Australia, residential house. Now, what you have to keep in mind is, if we have a house, that does not mean it will be subject to IRIT only under two circumstances. I have to occupy it, or I have to close it down, no income. But if I have rented it to somebody, then the concept of IRIT does not come. Right? So that's important. And again, I repeat, this is not applicable on land. Right, again, the report, there is a reference to the net annual value concept that was there in our old Inland Revenue Act. But at the same time, we can see the concept of IRIT is different to the net annual value that was there under the old Act. Why? Under the old Act, the net annual value was applicable for commercial property as well as land also. It was not only houses, it was applicable to land as well as commercial property. So it's not exactly identical. Yes, there's been a concept like that, but it's different. So I've just reproduced the relevant sections from the old Act here. You can see it was on net annual value of any land and improvements. Net annual value of any land and improvements. So that captures land as well as the building, the structures that are there. And first, the C item, you can see if it is used for the issue of the business aspect of it, business structures as well as to the residential house, right? Okay, now let's see. Now the issue with regard to the exemption on the first residential property. After the issuance of this report, there have been expressions, pronouncements from the Sri Lankan policymakers saying that there will be an exemption for the first residential property. It's not there in the report, but I think it seems the intention of the Sri Lankan policymakers is different to that of the content in the IMF report. So going forward, it's interesting to see whether intention of the Sri Lankan policymakers will prevail or whether the content in the IMF report will prevail. Now, I'll give another example, another parallel in relation to this aspect with regard to the intention of the Sri Lankan policymakers and what comes into the law. You may recall once upon a time when capital gains tax was to be introduced in Sri Lanka, the budget proposals that year had the statement or the government or the proposal to say that any land and building below 10 years will attract capital gains tax at the rate of 10% was the budget proposal. But when Chapter 4 of the new act was introduced, what we have now in Sri Lanka is capital gains tax. It's not restricted to land and building. It covers all the assets. Not only the assets, it gets, right now it's basically gets extended to the liabilities also. All assets and the liabilities will attract, it's not correct to say capital gains, it's the the concept of realization of gains and realization of properties and liabilities, the gains or losses therefrom is the concept that we have in the Chapter 4 of the Inland Revenue Act. So basically, IMF policy that was included into the statute was actually not the intention of the policymakers at that time. The budget speech at that time gave the intention of the policymaker, but it is not that was basically incorporated into the Inland Revenue Act there. Right. So now this is again interesting. Now what is in blue here is reproduction from the IMF report. A similar tax was previously included in the Inland Revenue Act of 10 of 2006. Under this regime, primary residents were exempt and the assessed values for rating purposes were used to determine the base assessed value. Assessed values are low, right, as we all know. Given the broad exemption and the use of the outdated and downward biased annual values, the tax generated hardly any revenue. So basically, IMF is making an expression here in this report that once upon a time also we had this concept of the deemed income concept, and there was the exemption given to the first house primary residence. But at the same time, the IMF is making a statement in a negative way. In other words, it's saying that because of that broad exemption that was given, hardly any taxes were collected by the Inland Revenue Department. So in other words, they're saying IRIT should not have, I don't know, to me, when I read, the feel that I get is the IMF policymakers are saying there should not be exemptions other than the exempt threshold, and there should not be broad exemptions, because when you create broad exemptions by giving exemptions for the primary residents, you can't collect much taxes. To me, that is what I read. When I read this is what I get. So in that context, we have to ask, is the IMF intending to give an exemption for the first residential house? Though Sri Lankan policymakers' intention is different. Okay, in this slide, I have reproduced that first house exemption that was there in the old Inland Revenue Act, and you can see there shall be exempt from income tax the net annual value of not more than one place of residence owned by and occupied by or on behalf of the individual. So that is how the first house exemption was given in the old Inland Revenue Act. Now, when you look at the new Inland Revenue Act also, as you know, when it comes to the capital gains tax regime, also, if you disposed your residential house where you have owned it for 3 years, successively 3 years, and you have lived 2 years there, when you dispose that, when you sell that, again, that is not liable for tax. There is an exemption for that. Right. So this is the policy discrepancy that we see with regard to the IMF and the Sri Lankan policymaker. So Sri Lankan policymaker is saying that we are not trying to look at countrywide tax. We are only trying to look at high net worth individuals, and the first house will be exempt. Right. So if that's the case, I raised this question. Now we looked at in Greece. In Greece, what are they doing? They impute revenue on luxury living. You look at the swimming pools. Sorry, you own a swimming pool, and then in relation to that swimming pool, a tax to be paid. You own a car with a high engine capacity, then an income is imputed, deemed, and tax is collected. If you own helicopters, income is imputed and tax is collected on that. So that is called the taxing the luxury living, taxing the high net worth individuals concept. Now, with regard, a similar concept was brought into the Sri Lankan tax net in 2015 called mansion tax. It came in the Finance Act 10 of 2015. I can recall in the interim budget, mansion tax was to be 1 million on any mansions, that many mansions or in structures where with more than 5,000 square feet. But when this was enacted into law, that 5,000 became 10,000. So that only a fewer number of mansions were to be liable to pay 1 million tax. But I believe somewhere around 2018, mansion tax was abolished on the basis Sri Lanka has too many taxes and we should not introduce another new tax. So on that basis, the tax that was introduced in 2015 passed in the parliament, certified by the speaker. You can see certified on the 20th October 2015, was abolished without a single rupee being collected. So the first question that I'm asking, okay, there's another feature in that thing. When I asked from the Inland Revenue officers why this tax was not implemented, why did you not collect any taxes from that? Okay, they had a valid to say under section 35, there was a reference to regulation to be prescribed by the minister, and that regulation did not come. Therefore, no taxes were collected before it was abolished. The minister may make and regulate. You can see in section 35 here, the minister may make regulation in respect of all matters which are required to be prescribed or for which regulations are authorized to be made under this act. So because of that, they said, okay, we did not collect anything. But anyway, this was reviewed. So the question that I'm asking is, why go all the way to go for this imputed rental income tax if the idea is to tax the luxury living, if the idea is to tax the high net worth individuals? All you need to do is a very simple thing. Revive the mansion tax. Within a very short period, you can revive the mansion tax and issue this regulation if necessary, because it says the minister may make regulation, it's not a shall, and put this tax into operation so that the revenue that is needed for the 2025 could be collected immediately. Now, what you have to keep in mind is when you go through the administrative hassle that is contemplated, that is planned for to implement imputed rental income tax. You can see there's a database to be created or database to be updated, and then creation of a digital register, make an amendment to the notary's ordinance. So many administrative measures to be implemented within a very tight deadline. Deadline being 1st of April 2025. So which one is the better measure as a short-term measure if we are looking at collecting revenue? Because Sri Lanka is in a crisis situation. It is, all of us have to accept that. We need to collect the taxes. There's no doubt in relation to that. But the question is, where do you collect these taxes from? Where do you collect these taxes from? First principle in tax is taxes must be collected according to the ability to pay. Taxes must be collected from the persons with the broader shoulders, right? So those are fundamental principles with regard to the imposition of taxes. So I'm asking the question, why not tax luxury living if the intention is only achieving? This is exactly what's happening in Greece. Private cars with large engine power, swimming pools, helicopters, etc. The luxury item. So this is exactly what is happening. Again, I'm reproducing this slide here also. The special tax regime in Greece, where the concept of imputed income on acquisitions and possessions imposed in relation to the luxury items. Private cars with the large engine powers, airplanes, helicopters, swimming pools, so the boats, etc. Right, the next question is, how will IRIT become part of the Sri Lankan tax net? Will it come as a part of the Inland Revenue Act, a new chapter in the Inland Revenue Act, just like the concept of Chapter 4 in the Inland Revenue Act, what we call the capital gains chapter, or the gain or tax on gains and losses from realization of assets and liabilities chapter, a similar chapter to be introduced for IRIT. So in other words, it will become part of the income tax regime of Sri Lanka. And there is a reference to graduated tax rates to be applied. So would it, so definitely it's not going to be a flat tax rate that will be there for IRIT, like the capital gains tax, as I mentioned earlier. So the next point there is, what will be the progressive rate? Now, as you all know, individual income tax, we pay on progressive rates, 6, 12, 18, 24, 30, 36. Whether the same progressive rates will be used or a different set of rates will be used to tax this IRIT, imputed rent. Or alternatively, whether there will be a new tax statute for IRIT, imposition of IRIT, maybe via the Finance Act also. We have to keep our fingers crossed to see what policy will be taken. So that's the those are the important points with regard to the IRIT. Quickly, let's have a look at the special commodity levy being replaced with VAT. First and foremost, it is the right move to abolish the special commodity levy. What is the history with regard to this? Once upon a time in Sri Lanka, we had multiple VAT rates, basic rate, standard rate, and the luxury rate, and we had 5% VAT rate applicable on essential goods. So that rate was abolished, and other taxes that were applicable at the point of importation on essential goods were consolidated into the concept of special commodity levy. And minister was given the power to decide the tax rate applicable to the subjects under the special commodity levy. And that resulted in two things. One is, nobody challenged that SCL Act when it was introduced in mid-2000s. So the point is, there is an element in the SCL Act that is against the Constitution of Sri Lanka. According to the Constitution's Article 148, 152, etc., Sri Lankan Parliament should have the full power to control public finance. Because of the discretionary power given to the minister to decide the tax rate, the fact that Parliament loses the full control of public finance, the manner in which that mechanism is laid down in the Act, it is unconstitutional, but now it has been passed into law and nothing can be done in relation to that. But a similar statute called Special GST was published by way of a bill, and when it went to Supreme Court pointed out, because that consolidated tax, the discretion given to the minister to decide the rates, among other things, resulted in being violation of the Sri Lankan Constitution, and Supreme Court rejected to give a green light for it to go forward. So anyway, at this point, along with discretionary power given to the minister, resulting in many alleged scams, sugar scam, onion scam, etc., happening, IMF pointed out that discretionary taxes should be abolished from the Sri Lankan net. Amend the tax legislation to eliminate or restrict ministerial authority without prior parliamentary approval and ensure that such changes do not generate revenue losses. And that is the reason why I have taken this from the IMF diagnostic report in September 2023. So that is the recommendation coming directly from the IMF to implement that. Cabinet approved a resolution to abolish a special commodity levy with effect from 1st of January. And in consequence of that, only now the agreement is to replace special commodity levy with VAT. Up to that, it is perfect, correct? But the issue is the IMF, the proposal says so it will come at 18%. VAT will come at 18%. So once upon a time, when the essential goods were liable for VAT at the rate of 5%, now you can see it's going to go up to 18%. Coupled with, unless specific exemptions are introduced, those essential goods will attract other input duties also, custom duty, excise duty, cess, PAL, etc. Also. If that's going to happen, my limited knowledge of mathematics is the prices of the essential goods in the local market can increase substantially according to the policy to be adopted. Should it be 18% or should we have a lower VAT rate? Should we provide exemptions from the other import duties? And I have, so things that are liable for SSVL are given in this slide, essential goods like the sugar, dal, potatoes, onions, chilies, spreads, etc. And if you do this number, sorry, if you introduce VAT in at the rate of 18%, with all the other import duties coming, the prices of these goods can go up in the market. So I think, again, we need a little bit of more focus with regard to the rates to be applied and whether exemption should be given from the other import duties to ensure these essential items will not go up in the marketplace. Right, VAT on supplier digital services, I think I referred to this at the beginning a bit. So what is going to happen is VAT is to be introduced. Which mechanism will be used, I'm not sure. What we need to keep in mind is when you look at the charging section of the Sri Lankan VAT Act, supply of goods and supply of services in Sri Lanka is liable for tax. We call it a taxable activity. On the other hand, importation of goods are also liable for VAT, but importation of services are not liable for VAT because it is not a part of the charging section of the VAT Act of Sri Lanka. So if you are going to impose VAT on the basis of it is an importation of a service, then we need to amend the charging section, and maybe we can even look at introducing this concept of reverse charge mechanism, another technique that is being used in relation to collecting VAT from non-residents providing services to a foreign country. It's another technique that is being used. And also we have to keep in mind something interesting also. Even if you look at the Sri Lankan Act, it says a person supplying goods or services in Sri Lanka, either directly or through an agent, is liable for VAT. Whether that interpretation could be used to collect VAT from the non-resident digital service providers is something that policymakers have to check. And what exactly is the amendment that is to be carried out to the VAT Act. So having said that thing, I have to also point out one of the reasons why countries are trying to impose taxes on non-resident digital services providers is to create tax parity between the non-resident provider and the resident provider of the digital services. So if you are looking at from that angle, imposition of the VAT is not sufficient. Why? Because the Sri Lankan digital service providers are liable for all the taxes in Sri Lanka, including income tax, VAT, and social security contribution levy. So just by imposing VAT, still we are not creating the tax parity between the local and the non-resident digital service providers. So what is happening in other countries? In some of the countries, they introduce a unique tax to capture taxes, to collect taxes from non-resident digital service providers. In certain countries, that's called digital service tax. India, the term used is equalization levy. That is where basically you bring a unique tax statute, a unique tax to capture this business activity. And in certain countries, amendments are introduced to the existing income tax and the VAT Act to ensure non-resident digital service providers would be liable for tax. So the point is, start is good, but at the same time, we need to do more work in relation to imposition of taxes on the non-residents providing the digital services in order to create tax parity with the resident digital service providers. Right, the sensitive one. Foreign currency service providers, foreign currency earners by providing services to persons outside Sri Lanka, that removal is going on. Where is that exemption coming from? That exemption is coming from third schedule of the Inland Revenue Act, where all the exemptions are there. So I believe with a simple surgery, that exemption will be taken out. So moment you do that thing, the service exporters will also be liable for tax in the same way the exporters of goods. Is it good? Is it bad? You can argue both ways. There's a school of thought to say that there should be equity between exporters of goods as well as exporters of services. Why are we giving a special exemption to the service exporters when the goods exporters are being liable at the rate of 30% on school of thought? So the next one is, right, what will be the adverse consequence to the Sri Lankan economy if we remove this exemption? In case of exporters of goods, if they don't bring the money back to Sri Lanka, since the nature of the activity, the records are there, I believe it's possible to track and tax that. But when it comes to service providers, there could be many structuring arrangements that could be carried out to ensure the foreign currency will not come to Sri Lanka. Or in other words, many structures could be used to park the foreign currency, the consideration outside Sri Lanka without bringing it to Sri Lanka to avoid the tax. So will that happen? So that is something, again, the policymakers should be mindful. If you're trying to create equity, that is well and good, but at the same time, it should not have an adverse impact on the economy by compelling or by tempting the service exporters to retain the money outside Sri Lanka and not to bring to the Sri Lankan economy, the problem that we are facing right now. Right, again, if you are in the IMF program, we have to permit free trade. We cannot have restrictions with regard to the imports what we have in Sri Lanka right now. And that is to be gradually phased out. So as a part of it, in relation to the motor vehicles, gradually that import restriction will be removed. And by, I think, somewhere in the middle of 2025 is the timeline given. And there's a reference to that in a phased out manner to do that thing. And also, there's an amendment that lifting the import ban on the motor vehicle can contribute to the GDP by 0.8% of the GDP there. And that's one. And again, with regard to another sensitive issue in the local market, the abolition of the SVAT. So in the March report, there was a reference to abolish the SVAT system by expediting the VAT refund process in Sri Lanka. So the deadline for abolishing the SVAT is 1st of April 2025. So what do we have in the latest report, the June report? So you can see in that one, there's a reference to policymakers have already initiated work to fix the VAT refund system to ensure full repeal of the SVAT system by April 2025. So look at the phrase, the initiated work to fix the VAT refund system. So in other words, again, there's a reference to ensuring efficient VAT refund system prior to abolition of the SVAT. In December 2023, Cabinet adopted a strategy laying out a gradual multi-step process to fully repeal the SVAT by April 2025. It's a structural benchmark. Then it goes on to say, all this is from IMF report. A committee has been formed. A committee has been formed to oversee the SVAT repeal, and its role and responsibilities will be specified in coming months, working in conjunction with the Risk Management Committee of the IRD. And then again, it says, given the tight deadline to repeal the SVAT and transition to a new refund program, IRD will prepare a project management plan with concrete next step by the end of April 2024. End of April 2024 is no more. It has now we are in July. So whether this has happened is something that we can see. So what does it goes on to say? In addition, the following efforts would also be implemented. Identify the exporters that are eligible for the VAT refunds. Who are the eligibles that are eligible for the VAT refund? Then extract from IT system to give details of the eligible VAT payers, VAT taxpayers. Then there's the risk profiling of the exporters also mentioned. Then post-payment validation and verification procedure is also to be introduced. And then again, ensure adequate funding for the VAT refund account. So measures to ensure VAT refunds will happen. And also there's a reference to a deadline. Somewhere in September 24, there has to be a testing of these new procedures would begin. To start this testing these procedures by September 2024. Right, so these are contents in the IMF report. To what extent it's happening, I don't have the knowledge as of now. So that's the last. Okay, then there's also another reference to a surgery to be carried out with regard to the stamp duty rates in Sri Lanka. Now, important thing here, what we have to keep in mind is stamp duty in Sri Lanka is coming from two statutes. We have the Stamp Duty Special Provisions Act, where the Commissioner General of Inland Revenue is collecting stamp duty from specified institutions. So that money comes to the Commissioner General Inland Revenue. Again, stamp duty on what do we say? Stamp duty on leases, land leases, is a subject under the provincial councils. Why? Because the 13th Amendment to the Constitution devolved certain tax measures to the provincial councils. The Parliament cannot take over that subject without the approval from the specific provincial council. So transfer of land, stamp duty goes to provincial council, but lease of land, stamp duty goes to Commissioner General Inland Revenue according to the current legal framework. And what is the rate that is used for levying stamp duty on the leases? It is 1%, not 0.01%. In the IMF report, there is a reference to current 0.01% being increased to 0.2%. And again, I get the impression when you read this report, there is a mistake that is happening here, because the draft of this report or the policymaker seems to believe that stamp duty on leases are going to the provincial councils, and if the stamp duty rate is increased, there will be more revenue coming to the provincial councils, and therefore there need not be transfers happening from the center to the provincial councils, and therefore the expenses of the center will go down, which is not correct, because the assumption that currently the stamp duty on leases are being collected by the provincial councils is not correct. And also the stamp duty rate on leases is not 0.01%, it is 1%. So I think this entire content that is referred to here is not correct. I think IMF, there's oversight here, and this has to revisit. The relevant gazette where it says the stamp duty rate is 1% in relation to leases and not 0.1%. Right, then this is my last slide before we go for Q&A session. Now, this is the interesting thing. Earlier, I pointed out in the IMF report, there's a reference to Cabinet having approved the revenue measures, the content of this IMF report. Cabinet has approved and imputed rental tax to be presented in the Parliament end of June, and parliamentary approval, that means the passing into the law, to happen before the end of July. And at the page 26, you can see there's another interesting one. It says, new structural benchmarks are proposed to seek the parliamentary approval of the revenue measures for the 2025 budget. Not just the imputed rental income tax, revenue measures for the 2025 budget ahead of the presidential elections, and expedite the preparatory work needed to introduce the imputed rental tax and implement the 2025 revenue measures. So it's an interesting comment. There could be many ramifications in relation to this statement. At the same time, the practical consideration should also be taken into account in relation to these issues. Right. So this is the bit of a long presentation, but these are the essential points in relation to the tax measures that are mentioned in the IMF report. So with that, Professor, we can move to the Q&A session.
Thank you very much, Mr. Suresh, for your detailed presentation. Next on agenda is the panel discussion. Mr. N.R. Gajendran, Senior Partner, Gashma & Company, and Mr. Atula Ranavira, Managing Partner, Ranavira Associates, will be joining as panelists with the presenter Suresh Pereira and Professor Lakshman Arvela. The session will be moderated by Mr. Sulaiman, Partner, Tax at Ernst & Young. We invite the participants to send your question through Q&A. Over to you, Mr. Sulaiman.
Thank you, Gajendra. So I'd like to invite both Mr. N.R. Gajendran and Mr. Atula Ranavira to switch on your mic. So if we can just, I think, before we go into the Q&A, we get a brief sort of synopsis of this in terms of a view of each of these areas covered by Suresh. I think we can perhaps go half-half in terms of the areas like we had imputed rent, we had removal of SVAT, imposition of VAT on digital services, change of stamp duty, etc. If you'd like to take about maybe 4 each, or however you have structured it, starting with Mr. Ranavira, quick synopsis on your thoughts on the tax reforms for about 10 minutes, and then Mr. Gajendran thereafter, and then we'll move on to Q&A if that's okay.
Good afternoon, everybody. Thank you very much for the opportunity. Right now, as for the IMF report, now they have given a couple of tax proposals. Now, when we take these tax proposals, the main items are, as Mr. Suresh detailed, this imputed tax on property. There, as he specifically mentioned, it is only on residential properties and on individual owned residential property, whether you are occupying or otherwise. Now, with this, now still they have not decided the tax rates or whatever those details, but for them to recover the amount what they are expecting, it is very doubtful whether they'll be in a position to recover that much of money through this. Because now, ultimately, bare lands or any lands are not covered with that. Then, non-individual owning properties are also not covered. Now, those two are very important. Now, with that, I have my doubt that the quantum of income what they have budgeted will be able to recover that money. Then the service, the other thing is this electronic service VAT. Yes, it has to be there because that's a thing what we were expecting for a long time, mainly to have a proper competition in the local market. There are some people who are not paying VAT and some people who are liable to VAT and paying, very difficult for them to compete each other. Therefore, it is very much important. But as Suresh said, for import of service, if we are to charge VAT, we have to do a drastic change in our VAT law. That is very much important. That is that. Then I noticed one item in the IMF which is so important, to have a common valuation base for properties. That's very important. Now, it is proposing to have a common valuation which could be utilized for all purposes with relate to all type of taxes in Sri Lanka. Yes, if we can do that, so much better, because now we know provincial councils, revenue office, they are valuing for rate charges. That is one value. Then under the Inland Revenue Act, under Section 38, there's another valuation thing for capital gain tax calculation. Now, at the same time, we have a separate professional association in Sri Lanka, professional body in Sri Lanka, who for valuation profession. Now, but unfortunately, as for the Section 38 of the Inland Revenue Act, the tax assessors, the tax officials, we call them as tax officials, even they are not, they may not be having the valuation qualification, but they can overrule the professional valuer's valuation. Right, I think that is one of the biggest mistake which has happened in the amendment to the Inland Revenue Act. At that time, I don't think we have noticed that. As a result, even the Valuation Institute may have not noticed that during the building stage, and ultimately it got legalized. Now, to overcome all these issues, I think this proposal, IMF proposal, of to go for a common valuation system, which is accessible by all revenue authorities, including the Provincial Council revenue authorities. That's one of the best proposal what they have given. Then with relate to the, as Suresh also pointed out, there are some technical errors in the lease charge, the stamp duty or lease. I think they have to rectify that error. But anyway, with all these things, the IMF plan is to increase the tax revenue, from 12.4% of the GDP to 13.9%, increased by 1.5%. Now, how they are increasing this one, how they are covering this 1.5%, they have given a breakup of that. Out of these things, this property, the imputed tax is one of the most important thing in that. And the other thing is this, the service value, VAT on services. And at the same time, this service export, now they are proposing to remove the exemption on service export. How that will affect to the economy of the country? Because at present, it is an open secret that a lot of our IT companies, they incorporated companies in Dubai and some other countries, especially in Dubai or Middle East countries. And they diverted their business into that Middle East, the office opened or company opened in Middle East. There, the taxes are very much lesser than ours. And as a result, they are providing those services from those countries to the Western countries and earn money into those countries. Then they remit, as and when they require, they can remit some money to Sri Lanka, or they can save that money in that country. Now, by charging, now at least at present, the export of service is exempted under item 3, U3 of the third schedule to the Act. Now, it is easy for them to just remove that. But once they remove it, what will be the foreign currency income to the country? Therefore, before taking that decision, I feel that the government has to consider the possible effects to the foreign currency income inflow to the country. That's all for the time being. If there are any questions, we'll discuss this. Thank you.
Thank you, Mr. Ranavira. Mr. N.R. Gajendran, your initial views on the proposals at large. If you want to go into anything specific, please do for about 10 minutes. Thank you.
Thank you, Mr. Basically, if you see the IMF in the summary, they have said the debt sustainability of Sri Lanka is knife-edged. When you say knife-edged, the meaning is you don't know what's going to happen for the future. Anything can happen, good, bad, and ugly. Anything has equal chances of happening. So much of great uncertainty. I think the great uncertainty is coming because of the political situation in the country primarily, because we are going in for elections. And in the same breath, Suresh Prera showed a slide that was the slide that was in larger characters, but he sold it very mildly, where the IMF is expecting the government to enact this 2025 proposal by somewhere in August for 25 proposal. Basically, all these multilateral agencies respect whatever said, and then they respect the legislature. The legislature shoots down any of their proposals, they go with it. Now, at this moment of time, they may be pushing because the legislator can be gone. You can go ahead with the changes. But also, then we have to see whether all these things can be revisited, because most of the major parties are saying that they want to revisit some of these draconian arbitrary provisions which are being imposed on the people, especially the individuals who are at the butt end of the whole thing. So in that case, there should have been an inclusive approach. They should have included these people also and had it, because now there is, there can be a lot of instability that coming. So the knife-edge situation is amplified there. Now, if you see for the proposals, with all the song and dance of the revenue proposals, there is nothing more to tax now. They are going to tax even notional income. This imputed rent income is notional income. Notional income is imaginary income, hypothetical, arbitrary income. They are taxing all this income. You are bringing the so-called digital service taxes, and we are trying to expand it. It's absurd to expand it. I can explain, we can discuss and debate on that. With that, we are reaching into 2023, our debt tax to GDP was about 9.8. We hardly achieved 10%. 23, we are hoping to achieve 12.4%, pretty high jump. Then in 25, with all these new proposals, we are, I think, it is mentioned, I don't know, Atula's slide also, I saw it was not presented, is going up to 14%. That's all. Don't forget, in the early 90s, our tax to GDP was 22%. My question is, where is this balance? 6 to 8%, and we are struggling to achieve these things. If you go into the most controversial proposals, which is debated, which is affecting even people, ordinary people again, because a lot of people have these residencies. they have inherited the residence. Anyhow, any person wants to put up a residence. Now, this imputed rent income is a notional income. Imputed rent income is a notional income. In this any tax has to survive some of the basic basic norm in imposition of tax. Equity, that is capacity pay. Simplicity, it should be simple and it should be understood. Convenience and the economy. Now, if you see this tax is, it's going to fail in all these tests. You are trying to impose unrealized gain. In the United States, I think when Trump's period, they were trying to impose tax on foreign investments. There are people who didn't on unrealized gains, who didn't bring back their investment with the reduction in the corporate rates to 21%. Now, one taxpayer has taken to courts, the Supreme Court, going on the basis of constitutionality, because you can't tax unrealized gains. On unrealized money's gains, you can't tax. Notional income is, again, I don't know whether we will have to check the constitutionality, whether you can tax a person on the basis of there is on imputed income, notionality of the income. And even Biden in his proposal, if he's trying to raise 500 billion over 10 years, again taxing unrealized capital gains over about 10,000 individuals who own over 100 million worth of assets. Now, these are, even in developed countries, it's being heavily challenged. Now, if you see, the equity, there is no principle of capacity to pay. If you say a person has 150,000 rupees is salary, say, income is 150,000. He has a house. By chance, with the tax threshold, I don't think, according to the parliament, finance minister said 90% of the houses will not be taxed because of the threshold. Or some are saying one house exemption should be given. But in the IMF report, there is nothing of the exemption. There is only a threshold, right? And if you are saying 90%, we are about 5 million houses. 90% goes, balance is 500,000 houses. How can you, now you have to have, how are you going to tax them? Now, if you are going to bring impute, there is no money that is coming into your pocket, but you are going to pay tax. As a person has, say, 150,000, by chance his residence, occupied residence is going to attract tax on this. And the tax is imputed on rent income at 150,000, say. Then he will pay almost 35,000 rupees a month. His salary is only 150,000. And if by the time his 200,000 is imputed, he will pay about 52,000 a month. There is no capacity to pay. This guy is otherwise on 150,000, he will be paying 3,000 a month, the salary. So he has no capacity to pay, and there is no way is practically it could be imposed on the lower rung people. Then even if with all these things, they are trying to achieve 0.15% of the GDP. If our GDP in 25 is 34 trillion, it's going to be about 50 billion. And in 2025, the year after, we are trying to achieve 0.4%. That is about 130 or 140 billion. How are you going to get this tax? From where are you going to get this tax of 140 billion? Is it practically achievable, and how are you? The next question is valuation. I think Suresh mentioned the valuation was a problem when it came to property tax. Here again, there is a valuation on rent. Taking, for example, now the net annual value concept was not controversial. Even the rating assessment by the municipality is not controversial, because those are also imputed tax. Imputed, they are getting, but they are taking only three basic elements. One is the extent of the land, extent of the house, and for the purpose it is used. Area, all that is irrelevant. Extent of the land, extent of the house, and the purpose it is. That's the reason the rating assessments are minimal. sometimes it's not so minimal for residential premises, and for commercial premises is high. But if you are going to impute rent income, say practicality. Now, if it depends, say even in certain commercial areas, say the wholesale areas, certain shops, it may be a small area, it may be dilapidated building condition, but they can attract a huge amount of value. Even the same road, different places at the entrance, if it is a retail shop at the entrance of the main road, it will attract higher value. And if you go down and if it is upstairs or something, it will be a lower value. So now, can you standardize this valuation by area and otherwise? And also the threshold, are you going to give a standardized threshold, or is it going to be area wise? If you are going to give, if you put a threshold based on Colombo city area threshold, mainly a lot of people will go out of the tax net. Then you can't raise the tax. Whether you are going to modify the threshold is going to say. The valuation also, if you see, generally valuation is done by the valuation department. Now, this time the sales price and rental register valuation is going to be done by an authority which has not been specified. And this authority will give this valuation to the Department of Inland Revenue, to the land registry, and to the valuation department also, and to the government. Now, when you have the simplicity, how can you, this valuation is given, they will give it, I don't think they are going to give it by house. It will be by some area wise, they will do a valuation. How will it be contested? Because always valuation is subjective. So when it is contested, and if it is a person who has 150,000 rupees income or 200,000 rupees income and is added up notional, has he got the means to contest it? Where is it? Then what will happen is corruption will be at its best. It will be widespread, So now, this you have to see whether we can practically impose this, because it's a notional tax. Notional. Special commodity levy, if you see, whether it is going to bring in a lot of revenue, the way Suresh said, if you are going to impose in the full-fledged, the way it is imposed in the other cases, it has to bring a lot of revenue. But what is expected is only 0.40% on this. That is, again, it's about 12-13 billion, right? You are trying to get 12-13 billion of it. So whether you can still get that by adjusting the special commodity levy rates, if at all, to get that 12-13 billion, or you're going to bring it, and then if you don't give the exemption, some of these essential items can be unaffordable once again. Then if you are talking of if you see the IMF in their report have only mentioned two things, that is the imputed rent income and the abolition of SVAT. Other things are coming in the Sri Lankan part of the report. And that is what they are agreeing, right? This removal of foreign services is not coming in the IMF part of the report, if I am correct. Only their part of the report is talking of imputed rental income tax and also the SVAT abolition. Before I come to the removal of foreign services, SVAT abolition, they have a strong case, because there is no other country in the world, I don't think, who have a system of SVAT. Refunds are given. Here, because of what happened many years ago, the officers who want to finally sign the refund voucher and the refund check, they are refusing to sign. Because what happened, the people who orchestrated the fraud, the famous VAT fraud many years ago, nothing happened to them, but the people who were part of this, where their names appeared and signature appears on the documentation, they were incarcerated. So now this is also, there is another thing that may have to look at, is the KPIs that the department, they have agreed with the Department of Inland Revenue. Even the VAT refund, any VAT refunds claim made after April 24, 90% of the VAT refunds refunds have to be made within 90 days. This is a new KPI that is the department has agreed with the IMF. And refunds made after July 94 to 2024, had to be refunded in 60 days. And when you go to December, it is October refunds made after October 45. This is the one they are trying to see from April next year when it is abolished. Within 45 days, you have to give the refunds. So there are not a lot of expectations and the agreements are coming with the even on the risk-based audits also, they are going to computer-based audits. They have agreed about by the end of March 25, at least few LTUs, there has to be risk-based audit. That is, the assessor can't decide on the audit. The technology has to decide on the audit. There are good things also on those types of things. Now, if you see the removal of foreign services, we have heard about remote working. You don't know where the people are working from. Sometimes there are people even in Sri Lanka working here with their laptops, but they are, working remotely, not they are in the country of employment. So here, if you are going to have the remote working system, you can have the remote invoicing. If you see, exports are going up from 2024, it was only 12 billion. 2021 also 12 billion. 2024 also export of goods is 12 billion. By 2029, we are going into only 16 billion. Whereas services is 6 billion in 2024. 2021 is about 2.5. Service exports have gone to 6.3 billion in 2024. And in 2029, we are going to hit about 8 billion. Now, whether this can, if you impose this tax, whether this will come, because as it was mentioned, services are invisible in that sense. Goodsmen has to go out. Now, if you are going to impose this tax, what about these IT companies? They will rebase. Even the industries are rebasing and relocating, because more than the tax, there is inconvenience of doing business still. Still, the conversion of currencies are there. So we have to see whether end of the day, what is there going to be taxed? What is the incentive for people to start up a business here, investments here? So this has to be, I don't think this has been scientifically analyzed or discussed or even debated. There is no public discussion on this. And even in the removal of foreign services, you are trying to raise only 0.04%. So on 24 billion GDP, you will raise about 13 billion rupees. Where is 13 billion rupees of talking of foreign services about 6 billion? How much will be challenged of our future revenue is another question. Service monies may not come here. So by and large, we are knife-edged. That is true, because some of the decision what we are taking may have long-term repercussions. And once these people depart from or exit from Sri Lanka, it's very difficult to get them back. All these IT companies are not going to be easily based in Sri Lanka. They'll rebase it somewhere else and get the people to work from all over the countrysides. So there is no issue. Services, similarly for any services, they will have offshore operations. There will be remote working and remote invoicing. I think that's enough for the time being.
Right. Thank you, Mr. Gajendran, for that overall outlook. So I think a lot of sort of negatives, a few positives as well, in terms of all of these new proposals. So I think what industry and businesses were calling for was stability in tax policy, right? At least, no major surprises going forward after the significant increases we had in income taxes, VAT, SSCL coming in. So the market has somehow adapted. With the greatest difficulty, consumers are paying about 20% on revenue of most of the goods and services that they buy. Having said that, these now a whole series of new reforms again for the third year, so it's like a third wave hitting businesses and consumers in terms of change in what you're expected to pay out as taxes, which is destabilizing, right? It's destabilizing to anyone who's doing a business, anyone who's earning a salary that's fixed. So to that extent, whilst it is destabilizing and negative, some positives to take out of this, I think, is that this property tax was always rooted for by the IMF. I think they said it from 2 years ago. Last year they made it more stronger, and this year they couldn't go ahead with it because of the constitutional impediment of taxing property being devolved to the provinces. And as a result, there was a lot of speculation in the market, I think, on some said wealth taxes are going to come. There was a talk of inheritance tax like the UK. Then there was property tax, stamp duty, people thought will go up. A lot of structuring also took place as a result. But I think on the positive side, what we are left with now in lieu of all of that is this imputed rental income only, right? So, and that to me looks somewhat of a positive because it is only going to be charged on residential property, so not on commercial. So even if an individual owns commercial property that is not rented, it's not going to be taxed, so positive. If you have rented out your property, you're not going to be taxed on this, another positive. Although not mentioned in this, but mentioned by the president, and I heard it's going into the law as well. The first house is going to be exempt, that's another positive. And on the positive side, it will also perhaps encourage people to give their unutilized properties on rent to avoid this tax, right? And that will also, I think, this budget of I think it was 0.4% of GDP, perhaps includes the rent the people start utilizing their properties better. And it's only on the extra property, right? It's not on the property you're going to live in. It's the extra properties that you bought as investments that's going to be left to be taxed under the imputed rental scheme. And that will probably encourage people to furnish it, rent it out. And then that will also add to additional rental income coming to the economy and thereby adding to GDP as well. So overall, when you compare this with a regressive inheritance tax, a regressive wealth tax, perhaps I think we've got the better half of the stick to be left with only this imputed tax. Of course, it does have its issues, which were discussed in terms of valuation. But I do agree with Mr. Ranavira that our property market is so unregulated, so there is no proper database of it. There is a significant risk that somebody can actually take over your property, right? Because there is no proper system of centralized database where you know who the owner is. There's so much of jugglery taking place with lawyers, etc., doing forged deeds. So this may be another positive that will bring in the proper database, a transparent database of all properties, their owners, what is our real land bank, and how the economy can probably utilize it better is something that this database that they're talking of will certainly bring in. That's on the ownership side. Valuation and then rental value, the imputed rental value. What I understand is that they are going to go with what rental agreements that have already been registered with those and then sort of derive an amount from that. So it won't be far from the truth in the sense that it won't be an arbitrary calculation. It will be rental agreements that are already registered, which are taking place between non-related parties. So to that extent, it will give a flavor of the market values. Of course, there'll be differences and arbitrary adjustments, but it will bring in some sort of parity in terms of what's happening in the market. So those are a few things on the imputed interest. If we move on to the digital tax or the VAT on digital services, again, like Suresh mentioned, there are positives and negatives. On the positive side, of course, there is significant amount of revenue leaving Sri Lanka to multinationals based abroad. If you take the top big tech companies, significant amount of advertising spend is going from Sri Lankan SMEs to them, like payments to Instagram, Facebook, etc. Airbnb and all of the hotel apps are deriving money from here. And if a local did that same thing, they would be liable to VAT and SSCL. So you are inconvenient or you are not in a level playing field by 20% of sales, which is significant. It can throw you out of the market. So to that extent, I think it is important to look at and bring some parity, but most countries go with a reduced rate. I think Singapore has also imposed VAT. So the market, again, the other side of it is they could think that, Sri Lanka is too small for them. I don't want to do this compliance. I don't want to register for that. And what sort of VAT registration process will be in place is the question. How will they have to register, file returns, and so forth. So other countries are doing it. I think the compliant countries will come in. So there is a source of income because these multinationals are used to it. As long as the system is a transparent system, is easy, perhaps there is a revenue source that is untapped at the moment, which shouldn't affect Sri Lankan businesses or consumers. So it has to be done in line with what other countries are doing so that they are not discouraged to go ahead with the compliance which they would want to do. Yes, there's also the increase in, I think it wasn't touched, corporate tax on alcohol, tobacco, betting. So the understanding is that there has been a reduction in most of these because of the high taxes at the moment and the huge grey and illicit market developing in both liquor and tobacco. And this will probably drive it more. So I think appropriate controls need to come in there as well if this is.
Mr. There are some questions, I think, in Q&A. Yeah.
So we'll go with the questions that have been raised, starting from the top itself. It says the CMC and other established Pradeshya Sabha charge annual taxes based on an assessment. Isn't this also in the same lines of property tax, IRIT, that is now proposed? Yeah, Suresh, you want to take that?
You're muted.
Yeah, this goes to the constitution of Sri Lanka before I go talk about the taxes here. So what we have in Sri Lanka is a unitary state. And then in 1987, due to the introduction of the 13th Amendment, we introduced this concept of devolution of the power to a certain extent. So we have devolved power to the central, so the provincial councils to a certain extent. So there are 3 lists in the 13th Amendment, and there's a list where there's a list where what you call the provincial council is the powers that have been given to the provincial council. So the areas that have been given to the provincial councils, only the provincial councils have the power to collect the taxes. Now, if the parliament is to collect taxes in relation to those areas, for instance, let's see turnover taxes in relation to wholesale and retail in that province, or collection of stamp duty with regard to the transfer deeds in those provinces, etc. Parliament can enact laws only if the specific province gives the consent. So if the province is not giving consent, then the parliament has no power to enter into that area. Then you have the scenario what we have in Sri Lanka now. Provincial councils are not in operation. So basically, you can't get the consent of the provincial councils to enact in relation to those subject matters in the parliament. So in this famous case of Fourth City Commission bill, when it went to Supreme Court, it was pointed out that since the provincial councils are not in operation, then it is possible for the parliament to go ahead and make laws in relation to that. So that's in relation to the devolution powers. Now, what I think the participant is asking is in relation to the what you call the rates that are collected by the, say, urban councils, municipal councils, Pradeshya Sabhas. Now, in addition to the concept of devolution of power that was introduced under the 13th Amendment, we have the concept of decentralization of the power. So what has been given to the power that has been given to the, say, the municipal councils to enact laws or regulations to collect taxes falls within that area, that decentralized powers. So there are statutes there are basically rules, regulations that have been passed by those councils. So yes, they're basically collecting those taxes there. So those will continue, in other words. So now the point is, those rates that are collected by those councils are in relation to the property. The imputed rental income tax is not in relation to the property. It is in relation to the income that is due to the person. It's not real income, it's the deemed income, potential income that would come to the owner of the property. So two different concepts there.
Right, thanks, Suresh. The other question, don't you think things like mansion tax without reference values will lead to corruption if the value of the swimming pool, yacht, etc. is subjective? Mr. Gajendran,
The mansion tax is not proposed now. So
not
that is not
proposed,
in
but
question.
it's a tax on wealth and tax on luxury, like Suresh mentioned. Is that an
So
option?
I
But
think
there
we
are-
shouldn't discuss anything, Nista, now which is not in the pipeline. That will complicate the matters. Mansion tax was there in the law and that is not there now. Now this imputed tax is the main one. That is my view now. Even the imputed tax, if what Nista said is correct, it may be that is one house going to be exempt. There are how many residences that people have, it's not occupied and left empty in this country. It can be counted in your fingertips. I don't think, either it's rented out or you're residing in them.
But all the
Very
apartments,
few
if you take all the apartments, I think
Yeah,
most
so
complexes 40% occupied, 60% unoccupied. So it's all bought for
unoccupied.
investment basically.
No, if it is occupied, it will be rented. If they are not
Or
renting
kept
it,
for
yes.
capital
But
appreciation.
now if the numbers we are looking at it is we are going to raise 50 billion in 25 and 150 billion in 26. So that is a large base we are looking at. So whether these, as you say, the property which are not rented out, so my thinking is there will be no exemption one house. There will be a value-based threshold. And once you surpass that threshold, that house will be taxed. That is the way you can collect the amount that they are proposing to collect. That is 50 billion in 25 and about 150 billion is 0.4% in 26 of the GDP. So that is 150 billion means if you, even if you take at 36% or whatever the rate, it's going to be that. The other one is these service taxes, this digital equalization levy and things like that. It is not coming as VAT or a consumption tax in most of the countries. It is coming as something like similar to income tax. In India, if you have your P in India, this equalization levy is not there because it's something equal to an income tax. And in these large countries, why they have introduced this main reason is because they have a huge population. And that is the reason this principle of double taxation of permanent establishment, carrying on business concept, they are saying no. India, China, particularly India, have said, look here, our base is 1 billion. You guys are making money out of our base. You are using our people, their databases. All this is being used. For that only they are imposing the tax. So we have to see whether it is income tax or consumption taxes. If it is consumption taxes, if you are going to get foreigners outside who have no business presence here, who are not a residence here, we are trying to impose taxes beyond our jurisdiction. Whether it is practically possible, what will happen is even in India is it's a withholding tax, digital service. Most of them are withholding. So if the payer will have to pay it, and the payer, if the supplier is strong, he will say, you pay the tax. Then it will be a cost to us, and it's a drain on foreign exchange also for us, because you have to, that fellow has to be paid more to pay the tax. So these things have to see, because we are a small country. We are trying to get into base, and we are trying to bring investments here. And what is that we can offer investors, particularly foreign investors, to come into this country to do business? And these are the people who are here are moving out. So industrialists have moved out. With these taxes coming in, service providers can move out. So it is heavily challenged. You have to see, we have to get the balance right here.
Yeah, so moving to the next question. Any other views, please feel free to jump in. Will there be a personal income tax charge on consultancy services provided to foreign customers when the income from these services are earned in foreign currency? Mr. Ranavira, if you want to take.
No, I think most probably that is not there in this IMF report. It says removal of corporate tax on service export. It says CIT on corporate, service export. That looks like that individuals' income seems to be continue to be exempted. Anyway, the
That may be way
removal
out, yeah.
yeah, the removal of
Yeah.
that section is very easy, as Suresh also said, because it's a matter of removal from that 13 U3, the third schedule U3. But now in this
That same thing is
I have a small problem question about I think Suresh, you may be in a position to give your response. Now, this proposal, it says out of this increase, they are planning 0.8% of the GDP by way of vehicle import. Relaxing the importation of vehicle, they are expecting the biggest percentage they are expecting from that 0.8% of the GDP.
pointed.
Now, yeah, is
Fine.
it for the benefit of countries' development or what? It's a collection of money held with the individuals or the corporate bodies by the government, not towards the development of the country. No, what's your idea on that?
Yeah, so I think what they're trying to point out is, because of the ban on importation of the motor vehicles, the border taxes have gone down during the past few years. So now, if you actually have the importation of the vehicles, at the point of collection of the border taxes, there will be an increase. But at the same time, you have to keep in mind, vehicles come at the same time, foreign currency also go out when you're buying motor vehicles. So it's a matter of basically comparing the two and coming to it. I just want to make a comment with regard to that earlier issue with regard to that corporate income tax thing. I think what process that has taken place here is there are certain points in relation to taxation that we have been discussing in webinars. Last time when the standard tax rates went up, we asked, okay, why is in industries the rates did not go up? And we saw some articles also saying that it should not be 40, it should be 40, it should be 50 or 55, that kind of thing. So I think it is that it's basically those comments that lobby groups or the policymakers that have pointed out that have been accommodated in this report. So this issue with regard to whether it is going to be all persons or only the corporate income tax is a question mark. I think what they meant is basically for the taxes to be the abolition of the exemption that is applicable to be taken out. I think that is what they are looking at. But then some who drafted this have gone and put it as corporate income tax. So if you see again in relation to the sin industries or the alcohol one also, they are talking about the corporate income tax, not in relation to a person. So in other words, okay, if
I
a
think
person
Suresh, on that, if you are looking at the table, it's in page 14 of the report. They say, as you say, increase corporate income tax 40 to 45, betting and gaming. For the elimination of exemption, income tax and export services. There they don't say corporate income tax.
I think the alcohol one is also there, no CIT.
For the services, no, only for the services they say that.
Only they don't say corporate income tax or export of services. It is services.
No, in another place, I think that is explained as CIT.
Yeah.
Must be in the table.
Actually,
it is
yeah, we noticed that one also, but somehow I think basically it's
Some
just
other
a
place it-
way of drafting. Yes, even in alcohol on check and say it's basically CIT.
Yeah, yeah, it says CIT. Yeah. In
So
the
the
table,
question
it says CIT.
Alcohol is CIT, but exporter service is not CIT.
Right. Yeah, so all ambiguous areas at the moment, just a statement so
No,
far.
I think we have to be very particular because IMF will stick to their words. That's all. So
They will-
generally
Yeah.
they stick to their
Yeah.
words. So the exemption is not mentioned, though we talk of exemption. So they will have to adjust with the threshold.
Correct.
Here also when they are saying CIT and this thing, because these are not coming part of their proposals.
Yeah,
This is
these are-
coming part of our proposal to achieve that 14%. What they have spoken is about only the VAT exemption and the imputed rate in their side of the report. Our
Yeah, so-
side only is expanding other because we had to increase 1.5% in 25 from 12.4 to we had to go to 13.9.
Yeah. So I think the status. I think the status of it is that it has gone to the legal draftsman, at least the imputed rent. I don't know whether all of the CIT will come in now and they're planning to pass it in July, is what I hear. So it will come to cabinet apparently towards the end of July and likely to get passed according to these rules. I think they have set these timelines very strictly, and it's most likely the government will go ahead with it. So in that amendment will be only the imputed interest of all the CIT related, like the 45% betting and gaming, the removal of the exemption on services, all of that is likely to come in. I didn't get that impression. I got only the impression of the imputed rent coming in. Do you all have any insights into that? Anyone else?
Practically, if you see,
Hmm.
this has to go before the parliament.
Yes, it will go.
Most of the members, even in the ruling party side,
Hmm.
they are not happy with the imputed tax.
No.
Whether it will go through the parliament and also the constitutional, because the way Suresh said this is a property-based tax. Now, if you see even the rating assessment, it's also, if you see, go behind there, this thing and say, they are also saying this imputed tax. So if you have a technical problem for importing taxes on property, this is imputed tax, this is not income tax. Right? So imputed tax also constitutionally that can be challenged. So whether the Supreme Court will shoot it down is another matter, because they will say this is not within your purview if it is the case. So there are all a lot of ifs and buts are there.
Correct.
Because this is, especially when it's a proposal for April 25, it comes with the budget. Now we don't have budget. They are on a voter
But
account.
This
They are not
says,
going to.
otherwise, no, Mr. Khan, the report itself says they have committed.
Yes, says the report is saying,
Go
but the
through the
report has to go through the parliament. No,
Yes, yes. So cabinet
parliament
is
has to go through
given. Yeah. So I think they're going to be very strong on it, perhaps. But you're right. There are so many ifs and buts. It can take so many turns given the process. You're right.
Yeah, I think what is important here is the timeline that is given. I think
That's
at one place
that's
in my last slide, I pointed
Yeah.
out there's a specific statement by the end of July, parliamentary approval should be obtained
correct.
for imputed rental tax. And there's another statement to say before the presidential election,
Yeah.
2025 revenue measures of the budget 2025 should be approved.
All
Yeah.
enacted.
No chance. No chance. Give it.
No chance.
So right.
So with regard to that other point, sorry, Suleiman, I think the question that we are discussing with regard to the what affects us, the foreign currency and a service providers thing,
Yes.
at page 86, the item number 8, in that one it says remove the CIT exemption on the export of services. So they are also the phrase
no?
CIT.
That is which part of the report?
Basically.
IMF or Sri Lankan part? IMF or Sri Lankan part?
This is page 86, item number 8.
Right. Okay, I'll check. Thanks.
So if that comes, then I think some relief for the at least the individuals who are also working, like Mr. Ranavira said, from Dubai and all that, they are getting that money here. Otherwise, they'll have to probably move out to get employed outside. So let's see how it comes through. I think we are out of time. We thank you, gentlemen, very much for your active participation. Very fruitful session, and I'll hand it over to Mr. SP Gajendra and Professor Lakshman.
Thank you, Sulaiman. Since we are running out of the time, I would like to invite Professor for the concluding remarks.
Thank you. I think I must thank everyone for the very informative and also the contents that were there, which I think a lot of us have been speaking on, especially the rental income. I think that was really one that is really of great importance. And the other one, of course, of the foreign direct investment and the services tax on the IT industry, and also for professionals. Now, earlier, I think they were able to get this tax relief if they're working in export industry. But now whether that is going to be done away with is something that we need to see, and of maybe investors shifting out. So that I think is a very dangerous signal. And we are really looking at expanding the IT industry. So I think this may need to be looked into because it also is the professional side is also affected, because we are trying to create professionals with the digital knowledge, and also maybe to bring in the foreign exchange required for the country. So maybe something that has to be looked into. But on the whole, I must thank all our panelists, and of course our paper presenter, Mr. Suresh Pereira, and our moderator for the excellent work that they have done. I'm sure there were quite a number of questions that have come in, and we now have to see how it is going to be implemented, especially with the political situation in the country. That's another which is not very stable, with so many voices being heard, and what will really go through. So considering all those, I think we have to wait and see how things will happen. So once again, let me thank everyone, and also Mr. Gajendra, who is the chairman of our taxation committee and maybe we need to take this forward and see how it will really be useful to everyone. I'm sure that we had a large number of participants. I think it was close to 450. So this shows that there is a great deal of maybe interest, and people are worried. And I only hope that our numbers going overseas will not start increasing with this sort of new taxes that will come in. So once again, let me thank everyone. And maybe Mr. Gajendra, you may have the last words that you can maybe speak on.
Yeah, thank you very much for Mr. Suresh Pereira for your valuable presentation, as well as for all the panelists, Mr. N.R. Gajendran, as well as Mr. Atula Ranavira, and for Mr. Sulaiman for the moderation done. And most of the request came, I think, to share the PowerPoint presentation. I think we can share it through for the registered participant with the permission of Mr. Suresh Pereira.
Yeah.
Then since we are already 10 minutes out of time, I will conclude the session now. Thank you very much, everyone.
Okay. Thank you, Gajendra. Thanks, everyone.